Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Terry Judge. He has a tax and engineering background, and he has been an entrepreneur for over 25 years. He's the founder of Core Solutions Group. His firm focuses on engineering-based cost segregation studies and other highly specialized tax credits and incentives, resulting in over $1 billion in net tax savings for his clients over the last 15 years. So thank you so much for being on the show today, Terry.
Yeah, so Charles, great to be here and super excited. We, that bio is a little bit old. I got to get my team to update that because we've been in business now for 19 years and we just hit $2.5 billion in tax savings.
Oh, wow. That's quite the difference.
Yeah, so I heard that 1 billion. I'm like, man, that's an old. They sent you the wrong bio, but it's okay.
So give us a little background on yourself. 25 years plus of being an entrepreneur. Can you kind of go over exactly, your background, both personally and professionally, prior to getting involved in what you're doing now, your cost segregation engineering business?
Yeah, so always been an entrepreneur at a very young age. Always doing things to make money. Always thinking, bigger than the normal 9-to-5 job that my mom and dad wanted me to do. So I went to engineering school. Or that was my college education, was going to be an engineer, mechanical engineering, and just knew deep down that that's not going to move the needle for me. And I always had this thing, in my gut that I wanted to be an entrepreneur. But coming from a family that nobody was an entrepreneur, in that regard, everybody worked for, I'm from Detroit. So you can imagine everybody my dad, my uncles all work in the automotive industry, GM, Chrysler, you name it. They worked there, and that's kind of where I grew up in, and didn't really want it. My brother followed my dad's footsteps, kind of did things that he did in that corporate sense, and then I really was the black sheep, always doing odd end things, and did so many different things before I landed opening up my company. When I was actually 34 years old, I started Core Solutions Group, which we'll talk a little bit about today, and that was in 2006. But before that, I was doing some consulting and advising, always in the usually commercial building space. I was in the energy. I got into the energy business at a young age. I was doing the deregulation of energy, where you could buy your gas and electricity kind of from a different retail supplier or for a discount, right? That was kind of the monopoly that was starting to break up in the early 90s, and was doing that. Got into some other energy efficiency type advising and consulting. And then lo and behold, this thing called cost segregation just landed on my lap. I was introduced to it by a CPA that was not doing it, by the way, but just, I don't even know how I was on their email list. It was just something that was sent to me and I was reading it. And then I immediately called my CPA and I said, what do you know of this? Because I always was intrigued about buildings in itself. I don't know why, but I've always was interested in that real estate. Ultimately wanted to get into real estate, even at a young age, and had some rental properties, back when I was in my early 20s. So that was always intriguing. And everything kind of came full circle when I got involved in this thing called cost segregation, which after I'm talking to not only my CPA, many different CPAs around the country, learning that nobody was doing this back in the early 2000s. I was just so intrigued by it. I'm like, why is nobody doing this? Why are CPAs not offering this? And I just found out that it was a very niche, people say, in the tax code. And it just wasn't something that CPAs offered. And I immediately, at 34 years old, I had a aha moment and realized that this was something that was missing in a lot of mainstream real estate investors. And we launched the company and it grew very rapidly. And then from there, learning, and working with a lot of real estate superstars that became clients of mine, I got I ended up getting in some syndications with them as a limited partner, and then moved into more of an active partner in different deals. So I can kind of get into what cost segregation is. And if we can go kind of keep it light, keep it deep, however you want to take this,
Yeah, no, it's interesting. You were talking about accountants not understanding all the different tax, because I find that when I speak to accountants now, and even I remember the qualified opportunity zone, I was talking to an accountant about that years back, and they didn't understand what it was. And I literally had to like email them something. So it's a lot of these things you just have to know when you're picking these professionals, whether there's attorneys, and make sure that they understand the strategies that you want to employ in what you're doing. And the same thing with your accountants, any of these people that you're working with. It's super important because I thought, being naive decades back when I started investing in multifamily, that every accountant would know everything, and it's very specialized, and knowing exactly what you're doing and then what they can expect. I think as you have more deals going on and more stuff happening, you have to keep those lines of communication open with the professionals that you're paying, and not just talking to them once a year or when you need them. You know what I mean? And so thanks for bringing that up, because that's an important thing I think that investors need to understand when they start building their team, is that kind of turn the table a little bit and interview them about who they're working for. Do you have investors that are doing what I'm doing and stuff like that?
That is so key. Your financial team and who you surround yourself with is so key, from a good real estate attorney to a real estate CPA, that has that background and understand. Maybe they're not offering cost segregation because CPAs don't offer this as a service, but they would partner with a company like mine. So, and just adding that in, and then adding somebody that from a cost seg background like myself to the financial team is very key, very important. I still find it being missed, underutilized, and an afterthought. And I spend a lot of my time on shows like this. I have my own podcast, really just educating people on how you can add this tax strategy into, the kind of the due diligence of a project. And it really moves the needle from as far as from a return on investment for investors. And so we just try to push this, up to the top of, make sure that this is part of your capital stack. This is part of your presentation or your pitch deck, and talking about how this can impact, not only the general partners, obviously, but the limited partners that are coming into the deal. If you're going to put $100,000, into an investment, you're going to be an owner. You're going to get some ownership of that property, which is a beautiful thing. And then you can also use cost segregation to minimize or basically eliminate any tax that you would pay on the income of that property as a paper loss. And there's obviously some other rules and whatnot. If you're getting into short-term rentals, there's another play for high net worth individuals. So it depends on everybody's situation when they're coming into a deal. If they're going to be buying a deal solo, maybe a fourplex, maybe they're just getting started. They want to get out of their W-2, where you can apply these tools and strategies, and it can really accelerate your wealth. And just getting around the right people, Charles, as you know, building your networks over the years, how important that is, and how much further along people can get if they're in the right rooms, getting the right information, then executing, building their financial team, adding cost segregation and tax planning is just, it's so key. It's so critical as a part of the overall journey that everybody's on, right?
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Yeah, Terry. So let's break down for us what cost segregation is, and kind of how investors can utilize this in their strategy of investing.
Yeah, so for folks that don't know, it's been in the tax code since the late 60s. It's gone through so many variations and flavors. It was eliminated from the tax code in 1986, came back in the code in the early 90s, and nobody really knew about it. The IRS does a horrible job at promoting tax incentives, right? You're kind of on your own, right? And if your CPAs are not on the forefront of this stuff, sometimes they're not promoting it either. Now things have changed. Now most CPAs are getting and embracing this, but essentially cost segregation is just a way the IRS allows you to break apart a building and write it off, some cases up to 50% of the purchase price or construction cost in year one, and then it gets spread out over year 5. And then there's different buckets. For land improvements, it's 15 years, and the rest of it just depreciates over what we call the straight line method. But essentially, the IRS will allow us to come into a building and break apart the electrical, the plumbing, the irrigation, the parking lots, the curbs, hundreds and hundreds of components that make up the big cost of that building, where now they say that some of these assets are going to have wear and tear, and it's like a car. It depreciates as soon as you take it off the lot. It's the same thing. The clock starts ticking on a commercial building or a residential investment property, and certain things are going to wear out when the IRS basically says these certain components of that building, which is like the interior and a big portion of the exterior, can now be written off in year one. And instead of waiting the normal what we call the straight line method, let's say you bought a building, well, the IRS is going to say you can depreciate that property over the next 39 years. Or you could take this cost segregation road, which is another kind of avenue in the tax code, where you can now apply these new and improved rulings, and that property now can be written off over, like I said, 1 to 5 years. And what that does is that you can, all that front-loaded depreciation that you're taking in the early life of that building, you create real-time value of money. $1 today is worth more than $1 down the road. And I like to use the analogy, if you and I were to hit the lottery, we won $1 million, do we want to be paid out today, or do we want to wait and be paid out over 39 years, let's say? Well, the answer is today. You want to get that money in your pocket today to use it to grow your wealth. Why would you let the IRS hold on to your money for all that time when you can get it in today's dollars and accelerate your real estate journey? So that's really the concept. We're just basically breaking apart. It's like, think of it as it's like a forensic audit for your building. And we're breaking apart every component right down to the electrical jack, behind the wall, the wiring behind the wall, the carpet, the fixtures, the drop ceilings, non-load bearing walls, everything pretty much in the interior, especially if you're renovating it and you're building it out. All of that material and all of those components, or a big chunk of them, again, can be plucked out and then written off. And that's what we do from an engineering standpoint. We have to understand, when was that building originally constructed? What type of materials were used? Then we go to what's called permanency rules that the IRS has set out. And it basically means that if components are removed from the building, how much damage does it do? I mean, this is really where it gets granular. Why somebody just can't do a cost seg report willy-nilly. You don't want to mess with the IRS, so it has to be done according to their specs. And that's why we've been doing this for 19 years, never had a disallowance, Charles, just because we're doing it to the T. We're crossing the T's, dotting the I's. But when it's done properly, when it's done correctly, when it's a true engineering study, you get the huge bang for the buck. And what's nice about the cost seg, so if you're a real estate investor, what we would consider a real estate professional, you're doing real estate mostly for your career, you then can take this depreciation. Not only can you use it against income from the building, because you're generating rental income, but you also can use it against wages. You can use it against W-2 income, and you can use it against other income that if you have other properties. So it's not one for one. Excuse me. And that becomes a massive tool for folks that are doing real estate full time. So that's, and then if you're passive, there's other rules for you where you're just now, you can take the depreciation against the income that one particular building that you're an investor in. Maybe you're not an operator, you're just threw some money in as an investor, but you're still considered passive. You can then take it just one for one, whatever that income is generating, you can offset as well. So that's some of the nuances of, hopefully I answered the cost seg question.
Yeah, one of the things when the first time I think someone explained cost segregation to me, and I was a C class multifamily investor, and they were like, you put a faucet in there, that thing's not lasting the straight line 28 and a half years, right? And you're like, oh yeah, no, it's not. No, it's not. So you're depreciating that over that lifeline, which might be 5 years, right? 7 years if you're lucky, whatever it might be. And so you're like, okay, that makes perfect sense. So I'm not, I'm really getting the true depreciation on this. And then with all the bonus and all this other additional stuff that can happen, depending on who's in the White House and what's going on, that also changes, how much you can take. But I think one of the first things that with real estate is that I've learned that there's not really tax elimination strategies. It's really just delaying paying. And as you brought up, people miss too is the inflation portion of it. No matter what type of inflation period we're in, that can dramatically change, you know what I mean? Depending on how many years that you're delaying that payment, you know what I mean? Before you might have to pay that. So it just adds on to how powerful a strategy can be.
Yeah. And there's, now there's different layers. We've evolved as a company as well. So we're not just a cost segregation company anymore. We're really more of a higher level tax company for real estate investors per se. But so when our approach is, we take a look at whatever you've originally purchased, then we take a look at what are we going to be doing for renovations, and then what are we doing for the land itself, because there's different strategies to not only handle the renovations costs, because there's something called partial asset disposition that goes into our cost seg reports. If you've never heard of that, it's important to understand that when we get hired, we like to get in there before the renovation starts so we understand what's coming out, because the IRS basically says if you're going to be doing a heavy rehab and you're going to be tearing out, cabinetry and sinks and wiring and all that stuff that you would be throwing in the dumpster, well, those really have full depreciable values that we can calculate through what's called this DPAD, or this partial asset disposition study that we add into the report, which will monetize all the things that you're throwing in the garbage can. And people are like, what? The IRS will allow you to take another big hit on the depreciation. So that's why we can when we do this stuff correctly and we follow the timelines, we can really help our clients, get up towards 30, 40%, sometimes 50% of everything that they're spending if it's done, in sync. And so we can kind of capture that stuff. And then at the end of it, obviously we're getting the final change orders for renovation costs. So we do the as-built, we do the renovation tear-outs, and then we do the finishes at the end, which is like really a three-prong approach to maximize all of the available depreciation. Otherwise, certain things could get missed. And then we like to also do what's called a land allocation study. This is interesting. We've added an appraiser to a land appraisal to our team. And so we typically, when we see buildings that have a purchase price of about over 10 million, we like to make sure that we're allocating the real estate and the land separately. And we want to put as much as we can into the real estate so we can get more depreciation, because land does not depreciate in terms of normal, depreciation that we're talking about. So the land just gets separated, goes on the depreciation schedules as is. Usually it's an 85 to 15% split, 85% real estate, 15% to land. That's kind of the rule of thumb in the United States. But we like to see 90% pushed to real estate, or 93% pushed to real estate, and 7% to land. And that really moves the needle for our clients. So we'll do that legitimately and work with them, making sure that we have the best land and real estate allocation split as that building goes into service. And that's a big thing as well. For multifamily, one more thing I want to add. For multifamily, for hotels, senior living, when you're acquiring this property, it comes with a lot of furniture, fixtures, and equipment in there. It comes with desk and lawnmowers and rakes and computers and workout equipment and tractors and all these things that, your CPA is not going to walk on site and start with his clipboard trying to figure out what was acquired. And so we'll do what's called an FF&E report and furniture, fixtures, and equipment. And what we're finding is that it'll move the depreciation up around 4 to 5% additionally, right? So now we just did matter of fact, just this morning, we were kind of going over the numbers of one of our clients. He had, a multifamily property, and we did everything that I'm just sharing with you right now. And we were able to pick up another like 800 grand and it wasn't a huge property by just going in there and plucking out all these other things that I was sharing with you. And we're just about to finish the land allocation study, and that we're hoping that'll move it another 4 or 5%. So it'd probably be over $1 million in additional depreciation by making sure that we're approaching this correctly. And so I just wanted to share. We call this our premium cost seg study. It just has different layers. It gets a little overwhelming, but there are other layers within this cost seg world that you can get.
Yeah, it's interesting. I never even thought about the fixtures before like that, as in, that wasn't connected to the real estate. So that's great to know. One thing, first time I did a cost segregation years back on our first syndication, the first thing that I found with it, or the first question, one of them I had, was that how does it work with the CPA? And I think this is people that, so you're taking care of the study. My CPA doesn't know everything or that much about cost segregation, as we talked before, let's just say, for example. So if I'm a passive investor or I'm a GP and I get this report from you, how does this work with the accountants, and how does it work with, like, say there's I'm a limited partner and the GP tells me I'm going to get all this money off and depreciation, all this kind of stuff. Am I just getting a regular K1 with this information put in it? Like, how does that work?
Yeah, great question. I mean, again, it's communication at the highest level. We feel like when syndications are going really well, there's CPAs involved, the cost seg person's involved. There's good dialogue back and forth, whether it's email or conference calls. And when I've been involved in syndications where the communication was not good, and which leads to chaos. And when are we getting our K1s? How much is it going to be? You got the CPA that's handling the syndication at the top, and then you've got your own personal CPA on the side waiting for the K1 so they can finish your tax return. So I just think it's as long as everybody's in communication, as long as you're getting the documents from the cost seg study to your CPA in a timely fashion, and then also answering those questions. So we like to be available for questions and making sure that everything goes smooth. But so, CPAs, once they get the information, they understand this intimately. They know how to take our work and incorporate it into someone else's tax returns. So I just think it's timing and it's just good communication, and everything usually goes fairly smooth. There's no gotchas. Sometimes there's some questions based on if somebody went in with a 1031 exchange and they've got some more sophistication going on because they rolled their capital gains into this new project through a 1031, or they're coming out with they're investing through their IRA, or whatever those situations might be. So we're not a CPA firm, so we have to draw the line somewhere. We can't just give advice on accounting and their personal tax returns, so we really kind of back off. But we are pushing it all the way to the CPA's front door and saying, here are the numbers, here's our work papers, here's what the benefit's going to be. If you have any questions, please reach out to us and we will help guide that. There's also something called a 481 adjustment. That's a whole nother conversation. And that's basically if somebody has owned a property and never did a cost seg study, they feel like they've lost the opportunity. And we said, no, you have not lost the opportunity. The IRS will give you a one-time automatic consent. You can go back to the date you bought it. We usually go back about 10 years, and we'll recalculate all that depreciation. And we do not have to amend returns. So for those of you that are listening, you have property, you've never done a cost seg study in the past, we can go back, recalculate what that depreciation would be. You get to carry it forward in the current tax year. You do not have to amend returns, and that is what we call a 481 adjustment. And CPAs are like, what? And so they're like, oh, we're not, can CORE do that? And so 99% of the time, this is probably what I would consider the only CPA, I guess, service that we would offer, just because we've done it so many times and CPAs have done it so few times. They want us to do it. We can do it at half the cost, and we will run point on that accounting piece, which is just a change in accounting. Goes on a form called 3115. But that's all important. So just to answer your question, like, all these things will happen as long as everybody is communicating on what those things are and how important it is. And everybody's has a little bit of a unique, not everything, sometimes it goes super smooth and it's just cookie cutter and cut and dry, but there are some things that are unique to, everybody's situation that it has to be accounted for.
Yeah, no, that's a lot of great information. So for the GPs working directly, or the owners of the property work directly with cost segregation firm, will work directly with their CPA. And then if you're a limited partner and it's cost segregation, you're literally just getting a K1 with this information already done to it. And I've given my CPA many different K1s with cost segregation studies in them, or have been implemented into them with depreciation. And I've never had questions about it. So it's a very straightforward thing for CPAs. If you're a passive investor, don't worry about, all that stuff. It's an easy, forward the email to your CPAs. I tell people, and they should be able to take it from there. But one of the questions too is, talked about multifamily, talked about some other property. What are the other property types that you've done or that are available to do cost segregation? Because what have you been involved with doing, and what's the extent of this cost segregation ability?
Yeah, I mean, and I get asked this to answer your question, like, any asset class that is a investment property qualifies, even a residential home, which we got into a few years ago, and because of the Airbnb boom and people have portfolios of single family residential properties that they had no idea they even qualified for cost seg. So it's really, we see the highest ROI by far in an asset class right now is mobile home parks, and that's becoming more and more popular. I mean, we are writing off 70, 75%, 77% of the entire purchase price, because a lot of it's just land, and it's developed land, and all that land can be taken because of this thing called bonus depreciation. You don't have to spread it out over the course of time. Everything gets forwarded to year one, and you get, right now we're in what's called 60% bonus. We're hoping it retro backs to 100%. When Trump was in office, he instituted this thing which really put cost seg on steroids, as you probably know, Charles. And everybody in our world just went crazy with 100% bonus, because you didn't have to wait, a day. I mean, you really you bought the property, put it in service. We come and do the cost seg. You get 100% write off on everything that we can pluck out and move it into what we call personal property, which is just, that all the shorter life assets in a building qualify as personal property from a federal level. All that stuff can be written off, in year one. So so mobile parks by far would be the highest depreciable return on investment. I would say next would be, multifamily obviously is great. There's so many things that qualify as personal property that you can write off quickly. I would say hotels are phenomenal, senior living, and we're doing a lot of hotels. Office is starting to uptick a little bit. We're starting to see more office. There's a lot of repurpose going on after COVID. People are obviously back to work. There's a little bit of a hybrid thing going on, a lot more common space and open areas and this and that. And so we're starting to see that's good. And office also qualifies for something called qualified improvement property, which we can write upwards of 80% off of the renovation costs. That's a whole nother little tidbit or program that's available for investors when they're getting into office. Storage is great. Storage is another really high return, just because of sometimes the entire build of the storage, there's not a lot to them, will qualify as personal property. Same with mobile parks. That's why we can write off so much stuff, because most of it qualifies to be very favorable when we're doing our cost seg reports. So yeah, and then Airbnbs are great. I mean, obviously that's a huge boom around the country. People are looking for that second vacation home. They put it in an LLC. And well, I'll just touch on real quick. So when you if you're a high net worth individual, let's say a doctor or a lawyer, and you're like, God, I got to diversify. How do I do this? I'm getting hammered. Guys making $1 million a year, paying Uncle Sam upwards of 40% of his, all that goes to Uncle Sam. How do they mitigate their taxes? And so, we can advise where they would just go buy a short-term rental. And that's what I did a couple of years ago, and bought something down in Naples, Florida. That's where I've always wanted to have a spot. And it turned out where, we were able to do a cost seg. As long as you manage the property for 100 hours a year, you can qualify, you and your spouse, you can qualify for what's called material participation. And the IRS will now, they basically say that property now is it's a business. It's like an active activity. It's not passive. Therefore, the depreciation becomes active. We can then move it towards other active income, which would hit your W-2 wages, and or your spouse can go get a real estate license. Anything that can basically, work in your favor on qualifying for some of these programs, you now can, take this and use it against income. So now people are like, holy crap, okay, I'm gonna have a good year this year. I better go look for an investment property. So instead of just focusing on cash flow, their number one concern is depreciation. This is how they can justify going to buy a property, because even on call it a $600,000 property, your first year tax write-off is probably going to be close to 200,000 or more. And that you can slide that right over to your adjusted gross income. And again, your CPA will work with you on that after they get our cost seg study, and boom, you get this huge, kind of this tax break. And now you have a property that will eventually cash flow once you put renters in there. So that's a little tidbit for somebody that's a high net worth individual, maybe can't qualify as a real estate professional or a full-time real estate person, but they're looking for tax benefits and they're looking for cash flow, and they've always wanted a second home. This is their opportunity now. The IRS will allow you to kind of move into that and really maximize, you get your down payment back because you're saving so much money on your tax. It's like, what did you really pay for your down payment for that property? Probably zero. And people, once they understand, they're like, oh God, okay, I got to get off the fence and I got to go buy our dream or lake house or whatever that might be.
Terry, how does a secondary cost segregation work?
What do you mean a secondary?
Can you do a secondary cost segregation after owning a property? Is that possible? So you can do an additional one, or do you just do one when you purchase the property and that's it?
Oh, so I think I know what you're talking about. If somebody buys a property, are you talking about so they buy the property, and then are you saying that after they do the renovations, let's say in another tax year, or is that what you're considering a secondary? So we call that our piggyback. We're doing a mini report or a piggyback study. And it does. So the IRS basically states that anything that goes into service in whatever tax year, that counts for that particular year. For instance, someone buys a property, let's say in November of 24, like we're in November, right? Or we're almost in November, so we're in October, but let's just call it November. But the CapEx budget plan is not going to be finished until 25, right? Maybe April of 2025. So those renovations are going to be have start dates, or they're going to have in-service dates in 2025. And let's say that you're going to spend $500,000 on the renovation. So we would then do a mini study on the $500,000 in renovations, and basically add that into the original study, and then send that off to the CPA so it can be accounted for. So yes, it is called a secondary study.
Terry, as we're wrapping up here, one question that I don't think it's mentioned much when we're talking about these tax delay strategies within real estate. What happens when the property is sold, and how does depreciation recapture work? And how does that affect the investor and for them planning for it and everything?
So we get into recapture. We like to say that, hold time is about 3 to 5 years to really mitigate some of that recapture. We don't recommend doing a cost seg study if it's under 1 year for sure, right? Because that's usually a flip situation. And that's why wholesalers never really get to leverage what we're talking about today, because they're just in and out of a property and you're on the treadmill. with what we're talking about here is just moving it, making sure that you're keeping these properties long enough to where these the personal property has a declining balance. So let's say 3 to 5 years. A lot of the things that we wrote off now has basically on the books is of zero value, and those were what we considered a disposed asset. It doesn't have to be considered in the recapture analysis at the end of the property, so you're not getting hit. Now, if it's there's always that recapture that's lingering in the background. If you are rolling into a 1031 exchange, you don't have to worry about recapture. Okay, the only time you're really worrying about recapture is if you're not going to do a 1031 exchange. You're going to have this capital gains at a certain tax rate. So recapture gets hit on real property, and it also gets hit on your personal property. Personal property is what we're accelerating, okay? And that's always hit at ordinary income tax rates. So we're always kind of looking out for making sure we're mitigating any recapture on the back end. The situation is this: if you're going to sell and exit, you're going to have a profit. It's going to be taxed at a certain rate, and you're either going to pay it or you're going to have to plan for it. So we always suggest, hey, if it's a pretty big capital gain, you better put it into a 1031 exchange. If you don't have the time or energy to seek out another property within that time lot, which is 180 days you have to close, 45 days to identify, we suggest on the next property you buy, you cost seg it, you create all this new depreciation that will then offset the tax that you've had coming out of the original property. If someone says, I'm a one and done investor, I'm going to hold on to this property, or if I'm going to sell it, I'm just going to pay the tax. I don't want to buy, then I would say maybe cost seg is not the right play, because you have nothing to offset it on the end, if that makes sense. Okay, we can do a recapture analysis, and someone says, hey, Terry, we're buying this property at this. We're going to be exiting in 3 years. We think at this price. We can go into our software and actually run a recapture analysis to show the impact. But it's usually, even if there is recapture, it's not, it's at a lower rate if you do it correctly, and you're avoiding the higher rate if you didn't do it. So there's always this kind of arbitrage where you're always still so ahead of the game, as long as you're holding that property 3 to 5 years. That's how we advise our clients.
Yeah, that makes perfect sense. So Terry, thank you so much for all this information today. How can our listeners learn more about you and your business Core?
Yeah, you can always reach out to me directly. I'll just throw out my email. It's Terry Judge, just my name, at coreadvisors.net, Terry Judge at coreadvisors.net. Feel free to shoot me an email. Happy to do a no-cost analysis on any of your properties, answer any questions you might have. Or you can hit me up on any of the social feeds. You can find me on, pretty much everything, and feel free to reach out.
Well, that sounds great. Thank you so much for being on today, Terry. And I'll put all those links into the show notes, and looking forward to connecting with you here in the near future.
Thanks, Charles. Enjoyed it, man. Have a good day.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.